Okay, well, welcome everybody. It's 12 o'clock, so we're going to go ahead and get started with today's webinar, Investment Philosophy 101, an evidence-based approach. So my name is Vern Cushenberry. I serve as the Chief Investment Officer here at 2 West. I chair our investment committee, and together we're responsible for selecting and monitoring all of the investments on behalf of our clients. And today I'm going to walk you through our investment philosophy and give you some insights into the way we think internally. We'll start by acknowledging some truths about the world of investing that reveal themselves with a careful study of the markets. And then we'll examine what has worked in the past and perhaps more importantly, what has not worked in the past. And lastly, I'll share with you the investing framework we use in our investing committee. And I'll try to leave a little time at the end for Q&A, but if at any time during the webinar you have a question, just type it into the box and I'll try to address it as we go. So I want to begin with one of the tools that we find most useful for analyzing market history, which is this chart provided by our partners at Morningstar. And I'll apologize for the size here. There's more data on this chart than I can cover in 45 minutes. There's more data on this chart than I could probably cover in 2 hours. Just an absolute wealth of information. From this one chart, we can see and study how markets have fared in different environments, economic expansions, economic recessions, wars, and other major geopolitical events, inflationary periods, rising interest rate markets, presidential administrations, housing markets, and more. And yet this is still only a small fraction of what's required of us as market historians. Notwithstanding, it does a good job of illustrating the power of markets to create wealth over time. And our job as investors is to capture these returns the best we can. So let's look at what this chart tells us as I toggle over and zoom in a little bit. By looking at this gray line, if you can kind of see my cursor there, it's the third from the top. By looking at this gray line, we can see that the average return to a balanced portfolio of stocks and bonds over this time period dating back nearly 100 years has been 8.9%. That includes World War II, that includes the Great Depression, that includes Black Monday, the S&L bailout in the 80s, and more recently the bursting of the tech bubbles and housing bubbles. And throughout it all, markets still managed to generate an 8.9% rate of return to that balanced portfolio. So then the question becomes, how do we capture these market returns? And with the benefit of perfect hindsight, we know that formula. First, we need broad diversification. This accomplishes two things. It allows us to fully capture the power of the markets, and it allows us to do it with less risk. Next, we need low fees, and this is just absolutely crucial because it costs money to package up a mutual fund holding over 10,000 individual securities. And every fraction of a percentage point we pay a mutual fund company in management fees comes directly out of our returns. And then lastly, we need patience. These returns don't accrue evenly over time. Markets are as likely to be down next year as they are up, but given a sufficient time horizon, we can capture these returns. It just so happens to be on this last point where most investors fail. And you can see the magnitude of that on this next slide, which was, this data was shared with us by our friends at Oppenheimer, and shows that the returns to the average investor have underperformed all asset classes. A simple buy and hold strategy in any alternative shown here would have yielded higher returns. But investors lack patience, or rather, to put it more bluntly, investors get scared and they try to time the market during periods of volatility. This is called market timing, and there's a substantial body of evidence to show that it does not work. There's actually a name for this type of behavior, which is so detrimental. Academics call it myopic loss aversion. We have an academic study of the phenomenon in our resource library that was published by University of Chicago Professor Richard Thaler and Nobel Prize winning economists Daniel Kahneman and Amos Tversky. It's a little dry and technical, but very compelling, and it illustrates a phenomenon that's well known in our industry. The challenge with all this, and I hope this resonates with everybody listening today, the challenge with all this is the difference between knowing and doing. Most of us know how to exercise and eat right. It's just actually doing it that becomes the stumbling block. And similarly, a buy and hold strategy oftentimes runs contrary to the way we're wired as humans. These behavioral responses are in our DNA. I know it certainly holds true for me. And in addition to serving as the Chief Investment Officer here at 2 West, I teach finance and accounting in the master's program at the University of Missouri at Kansas City. I know this data backwards and forwards, and yet I'm not immune to the behavioral response. When I tune into CNBC and hear pundits like Jim Cramer shouting about the next market crisis in the wake of Britain exiting the EU, or the bailout of Greece, or Lehman Brothers collapse, or 9/11, I feel my pulse quicken and my blood pressure go up, and I have to remind myself that there is no evidence to support the conclusion that my retirement account would be better off if I just got out of the market altogether. And as a matter of fact, there's plenty of evidence to the contrary, but it's very difficult to keep a level head in the midst of such market turmoil, and that is what leads to the type of results that you see here on this chart. With this next slide, and I want you to focus on the left-hand side here, I want to unpack this point just a little bit more so that everyone listening today can better understand why this phenomenon exists, because it's just so tempting to believe that we should be able to forecast these storm clouds on the horizon and take cover in difficult markets. The problem with that theory is that we not only have to outsmart the market once, meaning that we have to sell before everybody else sells, but in order to continue to reap the long-term rewards of a buy and hold strategy, we have to be right twice, meaning that we have to accurately recognize the bottom and buy back in before the market snaps back. And given the reflexive nature of the market, that can be an extremely challenging task. So you consider the data on the left-hand side of this slide here, which looked at a 20-year period ending in 2015. Over this time period, if an investor would have missed just the 10 best days in the market, his or her return would have been cut in half. Miss the 20 best days, and your return is nearly cut to zero. Miss the 30 best days or more, and your return is negative. My intent in sharing this data is not to harp on the failures of individual investors, but rather to shed some light on some of the behavioral challenges and structural inefficiencies that face all investors. And this next slide shows that professional investors are no different. When investors choose to pay someone to manage their money, there has to be some way to measure what they are getting in return. And we measure this performance against an appropriate benchmark. I want you to think of a benchmark as a broadly diversified, low-cost strategy that the know-nothing investor would use to capture the average market returns that we analyzed on the Morningstar chart a minute ago. If a professional investor can't outperform a simple, low-cost, broadly diversified buy and hold strategy, then it begs the question, what are we paying for? And as you will see, the evidence against our industry is pretty grim. This is substantiated by many studies that have been done over the past 30 years This one in particular that you see here on this slide was done by our friends at Dimensional Funds who found that only 17% of equity managers managed to outperform a simple, low-cost, diversified buy and hold strategy, and the data was even worse for bond managers at only 7% over this 15-year period. So it becomes incumbent upon us here at 2 West to acknowledge this data and share it with you in a way that brings our task at hand into perspective when selecting mutual funds for our clients. We call this process of hiring an active portfolio manager, and by hiring an active portfolio manager, I mean anything other than opting for that simple, diversified, low-cost buy and hold approach. We call that process reaching for return. And an accurate way to interpret this data would be to say that when investors reach for return, the likelihood of success is less than 20%. Okay, so I'm sure you've recognized at this point that we're building a fairly strong case for a simple, low-cost, diversified buy and hold strategy, and for good reason, which is primarily that it's consistent with all of the data we can observe over the last 100 years. But really quick, I want to point out a couple more data points that put a finer point on it. And the first is this study done by Vanguard, which analyzes data submitted by the National Association of Collegiate Business Officers about the returns on their endowment portfolios. So these are academics, these are professors and other very educated investors who are familiar with the same data that we've reviewed today. And yet what we see is broad failure still, particularly among smaller endowment portfolios defined as those of less than $100 million. 90% of those portfolios have failed to outperform that same simple, low-cost, diversified buy and hold strategy. Okay, lastly, and perhaps most damning, let's point the camera at the consultants of the world. And by consultant here, I'm talking about those advisors who function in the same capacity as 2 West, selecting mutual funds and other investments to power retirement portfolios and other accounts. I want to draw your attention to a recent academic paper published last fall in the Journal of Finance. And keep in mind that the Journal of Finance is a top-tier academic journal. If you know anything about the world of academia, then you know that every junior professor in the world is clamoring to get tenure, and one of the ways you do that is by getting published. And the more prestigious the journal, the better your chances. That's basically just another indication that we have something very legitimate here in this study. And to make a long story short, I'll cut to the chase. And in analyzing the decision-making and fund selection of the largest consultants in our industry, overseeing hundreds of billions of dollars in capital, the authors found, and I quote, "We find no evidence that these recommendations add value, suggesting that the search for winners, encouraged and guided by investment consultants, is fruitless." Wow, now that's convicting. So why do I share all of this data? I share it because 2 West believes that we have to acknowledge this information, otherwise we condemn ourselves to repeat the same investing mistakes of the past. So where do we go from here? We've shown retail investors fail, we've shown institutional mutual fund managers fail, academics fail, consultants fail. So should we just invest in that simple, low-cost, diversified buy and hold strategy, or is there more to it? What I'd like to do is spend the next few minutes giving you some context around just how exactly we go about answering that question here at 2 West. But before I do, and at the risk of belaboring the point, I want to share one more study that again highlights just how important it is in our industry to keep a keen eye on fees. I'm fond of saying that there are only 2 things that we know with certainty in the world of investing, and that's the positive quantifiable effects of low fees and diversification. On both of those fronts, we have the basic math working in our favor, and insofar as fees are concerned, we can very clearly measure the impact. Moreover, as this study from Morningstar indicates, they have a predictive quality as well. And I want to give Morningstar kudos for publishing this paper, because I'm sure the tendency was to bury it, but to their credit, they shared it with the world, and I'm sure that was partly on account of a commitment to bettering their own processes internally, and that's admirable. Nonetheless, in this analysis, they break down the predictive power of low fees as compared to their own star rating system. And what they found was that investors would have been better off naively selecting mutual funds based on no other criteria than simply low cost than they would have been using Morningstar's own star rating system. That's powerful data, and it really helps to form the foundation from where we at 2 West begin the investing conversation. To expand on that conversation a little bit, I want to introduce our evidence-based investment philosophy and revisit the notion that I mentioned earlier of reaching for return. My hope is that this webinar has already left you with a certain feel for how we think. In a nutshell, we're very data-driven. We're focused on being able to support and substantiate and potentially defend any decision that we make on behalf of our clients. And we refer to this as our evidence-based investment philosophy. And we can certainly build and support a strong case for low cost and diversification based on that evidence. At 2 West, we consider this our default starting position for beginning a conversation about investing. Circling back to the question I asked a moment ago then, given all this evidence, do we just stop there? To a certain extent, the answer to that question will be unique to each client, because reaching for a return beyond this default position will always come with added risk. The framework we use to assess this trade-off is strength of evidence. And I want to talk about what that word evidence means for a minute, you see, because every investment advisor will point to some graph or chart or past return stream, and all of those serve as some form of quote unquote evidence, but we seek to hold ourselves to a higher standard, an academic standard. A moment ago, I talked about a study that had been published in the Journal of Finance and how prestigious that was. Well, that prestige is for good reason. It's very hard to get published in a top-tier academic journal like that. The research has to pass an exacting peer review process and be proven to be statistically significant and robust. The world of academia is competitive and represents some of the world's brightest minds, all seeking to expand on that body of knowledge, and therefore, the bar by which that research is measured is very, very high. The evidence-based investment philosophy is basically the scientific method applied to investing. Statistically speaking, we're looking for a testable hypothesis based on observable data that has occurred in the past. So let's look at one. Take for example the old adage, sell in May and go away. I suspect that this is a saying that many of you have heard, and it sticks in investors' minds because historically the summer months have been some of the more volatile on the calendar. It also happens to be a testable hypothesis. We can look back over the past 50, 60, 70 years, and our partners at Oppenheimer here did exactly that on the right-hand side of this slide, and we can calculate exactly what results this strategy would have yielded. And as I shared a few moments ago, you can see that the strategy fails miserably, and yet it persists. Okay, now I want to direct your attention to one of the primary examples of what has worked in the past and what we at 2 West would consider to be strong form evidence, and that is the return premium associated with value stocks and small stocks. This is a phenomenon that's widely known in our industry thanks to the Nobel Prize winning research of professors Eugene Fama and Ken French. Value stocks have a tendency to deliver higher returns to investors and have had over the last 90 years. This data shows the effects of segmenting a universe of stocks by size and value characteristics. And what we know to be true about the world of investing based on this data is that small stocks have a tendency to outperform and value stocks have a tendency to outperform. So at the margin, this strategy is strong enough to support a tilting of our investment portfolios in such a way that insofar as we are still keeping an eye on low cost and diversification, we can also proactively tilt our portfolio or slightly overweight those stocks in that universe that exhibit these characteristics. In other words, smaller stocks and value stocks. So this is the type of strong form evidence that we look for in guiding our decision-making process at 2 West. By requiring a higher standard, an academic standard, we have confidence that we're standing on the shoulders of giants in our industry, so to speak. And at times, as in this example, even leaning on research that has been recognized by a Nobel Prize. So my intent today wasn't to get too technical, but rather just to share an overview of our investing philosophy and some of the challenges that routinely plague investors of all kinds, not just do-it-yourselfers. So, with that, I want to say thank you and open it up for any Q&A that you might have. So I see one question that came through from one of our listeners today. It asks, what are value stocks? And that's a terrific question. The return premia that has been identified with small stocks is rather easy. We can all probably intuitively recognize that smaller stocks are our only opportunity to capitalize on the next great success story in the United States. But value stocks, how do we define that? Well, there's a variety of ways that we can look at that. The simplest measure is a price to earnings ratio. So what do we get in exchange for what we pay? And we can look at the price of a stock, and we can look at the earnings that stock generates on a per share basis and compute a price to earnings ratio. And the lower that ratio, the more value that would be embedded in that stock. And by ever so actively tilting a portfolio in that direction, we can show an opportunity to capitalize that over time. Okay, I have a number of other questions here. Let me see if I can. Okay, next question. Can I be too heavy in bonds? That question is going to be unique to every investor and will largely be determined by your individual circumstances. So if you're early on in the investing life cycle, meaning in your 20s, 30s, 40s, absolutely you can be too heavy in bonds. Most investors need a heavy equity exposure early on in the investing life cycle so that they can capture those market returns and reach retirement on schedule. If you're later on in your investing life cycle, particularly if you're at or near retirement or close to your decumulation phase, then a healthy bond allocation is probably necessary for your portfolio. Without knowing more about an individual investor's unique circumstances, it's difficult to answer that question, but it will have a lot to do with your specific time horizon. Next question, do you offer small cap value? Yes, we absolutely do offer small cap value. There's a number of ways to look at that question. We can take a universe of stocks, meaning large cap value, small cap value, large cap growth, small cap value. We can put them all inside of one mutual fund and tactically tilt them towards stocks with those characteristics that we're looking to capitalize on. Or we can segment the market a little bit differently and allow investors the opportunity to only invest in a smaller portion of the market and a value component of the market. So like I said, we guide this underneath the broader heading of reaching for return, and every time we reach for return, it will add an element of risk to your portfolio. So much like the previous question of can I have too many bonds in my portfolio, anytime we're talking about adding risk to a portfolio, it's going to be unique to an individual investor's specific circumstances. So, the more heavily we weighted small cap and the more heavily we weighted value, the earlier on in an investor's lifespan I would expect to see. Okay. So that another question is that image that I said I could talk about for 2 hours, is that available in larger form? It absolutely is. If you want to connect with 2 West, which is as simple as sending an email to info@2 West, we can send you the soft copy of that chart, and you can print it out and zoom in and look at how the markets did in different presidential administrations and inflationary environments. And there's such a wealth of data on that chart, and I would encourage you to reach out. We're happy to provide it, and you can study it in much greater detail. It is it's blown up on the wall in my office, and it's just such a wonderful resource. It really does provide a careful study of the long-term market environment. Okay, so not seeing any other questions. I will again say thank you for your time today and invite you to join us for another one of our upcoming webinars. These occur throughout the year on a variety of different topics, as you can see here. And keep in mind that on a quarterly basis, all of our attendees today are entered into a drawing for a $50 Visa signature gift card, and we give 10 of those away every quarter. So at the end of the quarter, we will draw for names. And thanks for tuning in. Let's hope this quarter that's you.